How does your retirement plan hold up if you retired into a Japan-light economy? That's what we're going to talk about here today. I've been thinking about this a lot. In fact, part of the book on my retirement, on the Retire with the Wellington Fund book, dedicated a chapter or two to this. This is a big deal. Hey, hold on just a second. I had to close the door because Pablo came bouncing in. Anyway, so this is the book, Retire with the Wellington Fund. If you haven't bought it yet, what are you waiting for? It's free on Kindle Unlimited. I don't know what I think $5.99 or something like that. Maybe $9.99 for the paperback. No one knows. No one knows where we're gonna go. But if you, we use these numbers, and I've heard this a million times a Sunday. Like the market always comes back. I hear that a lot. Or, you know, for every down year, there's 3 up or something like that. And I mean, I get all that. Or inflation is imminent because of federal printing press and whatnot. And I hear all that. And I say, okay, what if we're wrong? And I look at Japan as the most recent what if. And it's ugly, man. It's ugly. And then I look and I see the same demographics that we have as Japan. Not all of them. That's why I say a Japan light, L-I-T-E. And aging demographics, less and less consumer demand, thus less and less consumption, less and less borrowing. The Fed basically trying their hardest to get some inflation, just not working. Growth, now we got freaking dictatorships across America in these various states and counties. It's just, I mean, Santa Clara County, Governor Newsom, Ohio for Republicans, Massachusetts is led by a Republican. It's nuts. That's not growth oriented. If anything, it's deflationary oriented because people are losing their businesses, meaning they're losing their spending power, and the government who's shutting them down isn't giving them a reprieve. Rightly or wrong, it's nuts. So let's look at the models here. I'm going to share with you my on the halftime report, my book, again, Retire with Wellington. I'll put a link in the show notes. I want to talk about what you need to be thinking about for sure. Because remember, just real quick, stocks are based on 2 things and 2 things only. Well, there's 3 things stocks are based on, but only 2 are long term. The first is earnings growth year over year. Earnings growth year over year. The second is dividend yield. And the third is basically appreciation or depreciation, depending on the level of ability for people to pay a higher price per every dollar of earnings. That's the word I'm looking for. Confidence is probably it, or no confidence. So you see the 1982, we had a PE for the S&P 500 like 5 or something like that. There is no confidence in the markets. Now, the counter to that was you could buy a 30-year treasury paying 15 and a quarter, right? So, I mean, it kind of makes sense. The PEs were so low. Now it's the exact opposite. Now the PE ratios are high, and the 30-year treasury is paying 1.6, something like that. So we have a significant, we had 1982, the PE ratios are 8, the yields were low. Now it's the exact opposite. PE ratios are high, and yields yields on bonds are low, if that makes sense. It's a very interesting dynamic. But anyway, so what happened was no one had any faith. That's probably the word I'm looking for. Faith in the stock market as such. They weren't willing to pay much for $1 of earnings. Now I'm not saying it's faith in the stock market, but you have an ability for people to bid up shares. Tesla comes to mind. Amazon comes to mind. People are saying these are growth. These are the way of the future. I'm willing to pay a high price for $1 of earnings because I think in the future it'll pay off. Hold on just a second. That confidence is fleeting because what was confident yesterday is no longer so tomorrow and things of that nature. So really the stock market is based on 2 things and 2 things only is price to earnings ratio earnings growth year over year, EGYOY plus DY, dividend yield. That's it. And you can look at, I got it back there, Common Sense on Mutual Funds from John Bogle is back there someplace where you can get your own book to see exactly what that number is. Not the number, but the math, the equation that goes in there. All right, so let's go to this. I don't believe we're in heading, and I'm reading directly from this book, and this is, again, the halftime report, halfway through the book. I don't believe we're heading into inflationary, I'm going to start with the beginning. Before we move forward, let's analyze what we've learned so far. Inflation is the destroyer of retirement plans. Historically, recessions and even depressions have been a lot more manageable than high inflation. Thankfully, I don't believe we are heading to an inflationary time. I think Japan is more likely to be our future. The Japanese have had a high debt to GDP ratio for decades. low unemployment, low inflation, low bond yields, low growth, and an older population. Let me talk about the low unemployment thing because I think a lot of people think, oh, low unemployment, that increases demand. Well, no, I've talked to many people, manufacturing industries, gold, oil things, industry essentially across the country. They're 50, 55, 60, making, 120, 130,000 a year. And their companies are trying to sever them essentially in order to replace them with lower wage employees. That's just a fact. That's just a fact because labor is the number one cost to do business. So a company says, if I can lose one Tom at 120,000 plus his health care, because the health care is more expensive because he's in his mid 50s, and replace him with two Joes, that'll probably save you money. Now Joe is only going to get 45,000. You see what I'm saying? So Joe is less costly, even twice as Tom is, because he's only going to command $15 an hour and he's younger, so the healthcare costs are lower. And they're probably not doing a pension anymore. They're doing a defined contribution plan as well. So from an employer's perspective, yes, they have less unemployment, or even the same unemployment because they let go one guy, they're getting another guy back at a cheaper cost, or even two guys. They might even have less unemployment, but in terms of consumption, consumer power is actually decreased significantly. And future consumption as well, because not only is that salary decreased, but as well as the investment dollar that's going into 401k plans and pension plans, and the consumption that you can get off that pension as well. From 1990 to 2018, Japan averaged 0.47% annual inflation. In the 21st century, Japan has averaged inflation 0.09%, less than 0.1% for the last 20 years. Since 1990, their growth rate has been an anemic 1.14% and only 0.93% since 2000. Yields on their 10-year government bonds are actually negative currently, and they're only averaged 1.88% going back to 1990. The Nikkei, their version of the S&P 500, has averaged only 0.96%, less than 1% since 1990, and 3.84% since 2000. What to make of this? Well, if we use Japan as a proxy for a low return, low inflation environment, how would we stand? If we took 5% a year, we invested $100,000 in the Nikkei. We took 5% a year, adjusting with inflation, which is nominal or minimal at best. We ran out of money in 1998, 9 years later, because negative 38, negative 3, negative 26, negative 2, negative 21, negative 9. As you can see, now look at this. We started taking 5,000 a year out in 1990. It's only 5,655 8 years later because we've had minimal inflation. 3% on the front end, but negative in 1 year, 0.7, 0.14, 1.75, 0.66. As you can see, investing $100,000 and taking 5% initially and adjusting with inflation every year thereafter, we would have ran out of money in 9 years. When you're taking money and the markets are getting hammered, you are sunk. And from our own experience in the U.S., it is inflation that has sunk many retirement boats. That's not the only risk we face, as our friends in Japan show us. We have to worry about the big investment losses on the front end, the sequence of return risk. But let's keep looking at Japan. Here, what if you bought Japan bonds and still took only 5% a year out? Well, the year, the front on 10-year treasury is 6.96, 6.34, 5.33. You can see it's gradually getting lower and lower and lower and lower until we ran out of money right there in 2017. So you would have ran out of money in 28 years if you kept your money in bonds and took 5% a year out, even though the rates were getting progressively lower. In that above table, I'm using the yield on the 10-year Japanese bond as the rate of return for that specific year. In 1990, the 10-year was paying 6.9. In 2000, it was paying 1.74. In 2016, is negative. That yield is the return we get for those specific years. And again, remember, we started with $5,000 a year in 1990. Right? We had that $5,000 a year. We needed to pull 5,655 in 1998. So we started with 5,000 as our withdrawal need. We needed 5,600 and 9 years later. What do we need by the end of 2019? 5,600. Literally no inflation for the last 20 years. Isn't that crazy, man? Nuts. And again, if you took the 4% rule is silly. If you took 4% a year here, you're sunk anyway. That's on stocks. If you took 4% a year here, though, you're golden. Your money survived you, which is pretty cool. What can we take away from this? Stick with me and I'll show you. So what I want to show you here is we're going to go to trading economics. I got it up here someplace. Nope. Where is it? Hold on, right there. Nope. All right, let me pause real quick. Oh, right there, trading economics. There we go. And we're going to look at Japan right now. GDP year over year is negative 5.8. They've had a quarter over quarter 5.3, but look at the U.S. We had a quarter over quarter 33%. Interest rates in Japan are still negative. Inflation is still negative. Jobless rate is still low. Government budget is negative, just like the U.S. Government debt to GDP is 236%. 236% debt to GDP. I mean, so here's the U.S. Interest rates quarter. Inflation is 1.2. Jobless is higher than Japan. Government budget is negative. Debt to GDP is 106. So the debt to GDP is not the concern. It's just not. I'm sorry. But that's going to show inflation. Here's Italy, debt to GDP 134%. Inflation is negative 2. Nuts, huh? And if we look at debt to GDP, Italy, Japan, Singapore, their inflation is negative. U.S. is the only one of the top 4 that has a high, over 100%. Only 4 countries in the world have over 100% debt to GDP, and 3 of the 4 have negative inflation or deflation. U.S. has 106%, and our inflation is all at 1.2. Belgium has a 98, France 98, Spain 95. 0.5 is inflation, 0.2 is inflation, negative inflation for Spain. Egypt, well, that's kind of weird because that's not really a developed country so much. I mean, if you're Egyptian, you find that offensive. Sorry. Argentina, not really. Canada, 88, and their inflation rate is 0.7. So the only countries with any kind of inflation are Egypt, Argentina, Pakistan. I mean, it's just nuts, even though the debt to GDP is through the roof. If you look at the other way, debt to GDP here in Russia and UAE, Saudi Arabia, Venezuela, Chile, Taiwan, Nigeria, the inflation rate is 4, negative in UAE, high in Saudi Arabia, huge in Venezuela. Chile is 2, Taiwan is basically 0, and Nigeria is 14. So debt to GDP is certainly not an indicator of inflation by a stretch of imagination. It's just not. Anyway, so let's go back to Japan here. We'll click on Japan. And again, the issue that I have is what if we go into a Japan-like thing? And I said, well, remember in my book, I showed you that bonds saved us in Japan, right? Because we're getting a positive rate of return while the stock market is getting crushed and while inflation, by the way, was going down. So a positive rate of return while inflation is going down to deflation is wonderful. But then we see here, those days are over for Japan. I mean, let's look at the money. I think it's money right here. We want the 10-year deposit rate. No, we want the, is it government? Where is the, no, we want, where is that was money, was it not? Labor? No, it's not labor. GDP. Hold on, I want the debt. Government bond right here. So here's a government bond in Japan. The bonds aren't going to save us here. You can see going back to right here, 10-year Treasury. Going back to, how long does this go back here? We'll go to 25 years. Going back 25 years. So this is back to 1998, and we're at 2.44. Now we're sitting at less than, I mean, basically negative 0.01, 0.02. You see what I'm saying? Here's 0 right there. Yeah. I mean, look at that. So the bonds aren't going to save you. No, they're just not. Whereas they did save you in Japan in 1990 to 2020, they are not going to save you now. Stocks may or may not save you. That's what I was saying last night in my live stream. Stocks are like electrons. They're bounced all around, on an atom. So stocks, you generate some you make electrons move. They can do kind of whatever they want to do. They're going all over the place. That's not what bonds. Bonds are like what the proton, which is fixed at the nucleus if memory serves on my chemistry. But anyway, electrons are going crazy. You know what I'm saying? But bonds are pretty stable. They're just right there. So stocks are like electrons that there's no correlation between inflation or deflation in the returns of stocks. We just don't know. But we do know that if stocks go a la Japan, your goose is cooked. And what if that only went half of what Japan did for 10 years? And you're doomed, man. You're doomed. I don't know. So look, I have no bonds, none whatsoever, but I'm still adding to my portfolio. So if I were in where I am now and adding to my, not retiring, but add to my portfolio, and stocks went down 38, 3, 26, and I'm adding, dollar cost averaging, I'm loving life, man, for sure. If I'm retired and that happens, I'm in a world of hurt. Can't have that happen, man. You got to protect the downside right as you're ready to retire. Downside protection is more important than upside growth as you're getting ready to retire. And you look, and look, I might be wrong. We might not go Japan like. We might. If we don't, that's great. But but what if I'm wrong and we do? Or what if I'm right and we do? I mean, that's the thing. What if? So you don't want to put all your eggs in one basket when it comes to retirement planning, because if you're 62 years old today, you're leaving your crappy old job that's paying you $130,000 a year. You're not getting that job back. So protect both sides on it, and if that means err on the side of caution, that's better to err on the side of caution than to err to the side of being optimistic where it bites in the butt. All right, love to hear your thoughts. We'll see you.